Well, here we are again, another Tuesday evening, and nice to see everybody on. I'll just put the pre-show on for a second or two and give people a chance to come in. We're competing with the shenanigans down in Canberra tonight with the budget, but I'm glad to see that some people have decided that we're better value than listening to the Treasurer. So we probably won't directly get updates about the budget because you pick them up half-cocked when you're trying to do other things as well, but be an interesting discussion for another day. Got Damien on ready to come in a moment or two. It's a very warm evening here. The cicadas are going like mad, so it's the first time for months I've heard the cicadas, which means it must be pretty warm and it's pretty humid tonight. We had lots of thunder here earlier on as well. Just before we bring the show properly forward, let me just show you the dogs. There we are. They're asleep. Meteor's having a bit of a clean. She went out and got wet in the rain earlier on. Luna's sound asleep at the moment, so they'll probably be there most of the evening, unless she decides to come and sit on my lap halfway through, which is sometimes what happens. And that's pretty much it. So I'm going to take the pre-show off. I'm going to run the introduction. I'll be back with the main show in just a moment. Well, good evening and welcome to this live stream on the 25th of October 2022. Martin North from Digital Finance Analytics here. Great to have you on. And thanks for forsaking the budget presentation for our presentation. It's greatly appreciated. As always, I'll bring Damien in a second, but I just will remind you that we don't provide specific financial or legal advice on the channel. It's a general conversation. We do moderate the chat, but feel free to express your opinions in the chat, and I encourage a lot of toing and froing. I think that's part of what the channel offers. This is as at 25th of October. If you want to ask a question, then use @WalkTheWorld to make sure it gets into my queue. And I've also enabled Super Chat so that you can get your question to the top of the list, or indeed, if you'd like to make a contribution to what we do around here, it's always greatly appreciated. And on that vein, it's rather funny, really, for Jason to actually come in and say a round of drinks for Damien and Martin to show appreciation for their time. Thank you very much. Really appreciate that. Thank you so much. Excellent. Well, without further ado, I'm going to bring Damien in and we'll get going. Damien, hello.
How you going?
I'm very good. How are you doing?
Yeah, very well. Very well.
Another month flies by. It's pretty amazing, isn't it? Where she is going. I want a refund.
It's been an exciting one. Yeah, there's lots to talk about this time around.
Absolutely. Yeah. Well, let's get going by starting with just a little bit of what on earth is up with the markets, right? We've had ups and downs. We've had a couple of days where it's really started to go up again. Now, it seemed to me that was driven very much by a change in tune. It was an article in the Wall Street Journal saying maybe the Fed is going to be a little bit more gentle ahead. But there's still a 75 basis point early November. So what are they thinking?
Maybe well, that's right. And sort of, I think it was along the lines, isn't it, that maybe they'll stop doing 75 every time. They might slow down to like 25 or 50. It's like, so yeah. Look, it's an interesting it's an interesting take on the whole bad news is good news, I suppose, isn't it? It's the part about saying if I'm there's some good summaries I think I was reading in terms of strategists who are just sort of talking about what's going on and what their thoughts are. And why this might be a tradable rally and things like that. And basically the view behind the tradable rally is, look, there was so much selling that pushed the market down. You've got a bit of clear air. Maybe this reporting season isn't. You're definitely starting to see the start of the downturn, but maybe you won't even see real downgrades for another 3 months, or possibly even another, so that's sort of getting the third quarter numbers, possibly even the fourth quarter until, and that those numbers don't get reported until sort of early Feb. And so, the question there is there enough clear air in the next month or two, or the next few months to spark a bit of a stock market rally? And so, obviously the answer's been yes in the very short term. There's still a lot of dark storm clouds out there. I haven't seen anyone sort of who's suggesting that they're going to go away. I think probably the best argument, the best bullish argument. So there's one bullish argument, which is you've got a bit of time before the bad news really starts to hit. The other bullish argument is actually the markets have fallen a long way already. They've sort of preempted the downturn in earnings, and so therefore when the earnings downturn comes, you won't need to. The markets won't need to fall as much, and that they might even start rallying into that. That bit I'm not as certain on, because I feel as if there was a chunk of it was like markets they just got so expensive in terms of the price to earnings ratios and things like that. I think the first part we've seen is really just that froth coming out of the market, where it's like, oh, okay, the Fed's no longer sitting out there printing, and every central bank isn't out there printing all this money and keeping interest rates low. I think that was the sort of first leg down. Now the question is, when you do get the genuine impacts in terms of earnings, do you see the next leg down? And I still think the answer is yes, but there's people out there arguing that no, you won't, or you won't see as much.
No, and it's interesting because the earnings so far this quarter, they've been a bit all over the place, right? So the overall expectation is quite a lot lower than last quarter in the US. And some have actually done better than expected, but a lot have done worse as well. Even the banks were very variable. So there's no real uniformity in terms of performance.
No, absolutely not. And it's always hard, and for anyone who's listened to me talk on these before, the problem with a lot of earnings, and in particular the US ones, is that they're very focused on beating the number on the day. And so what you'll see is that they'll be forecasting, 10 cents earnings per share up until the 30th of September, and then the company starts doing their accounts, and they pretty quickly work out, actually, we're not going to do 10 cents. It's probably going to be more like 6 or 7. And so they come out to the market and they say, hey, we haven't finished our numbers yet, but we're still working through. We think it's going to be more like 6 cents a share. And the market promptly, everyone downgrades their earnings, and then the company comes out and it wasn't 6 cents, it was 7 cents. Yep. And that's a beat. Yep. And despite the fact it's 30% lower than what people were expecting. And so I guess the hard part is for me is saying what's a beat and what's not a beat. I tend to then look at earnings forecasts and what are they doing to next year's numbers, because that's as good of a measure as what you're going to get anywhere. And what you tend to see is that this reporting season is where the US guys start to really look at their numbers for 2023. So they would have had in Q2 that they still got the numbers, but there's still 2 more quarters to go, and that's a long time, and who knows what will happen by then. So they sort of just they don't really pay that much attention to it. Whereas you start to this one, and then definitely next one is where the focus then switches very much to 2023. But you'll start to see that, and so far we're seeing mild downgrades to 2023. Nothing major, but and it's I think the materials sector was sort of holding up all right, but most other sectors were seeing sort of downgrades.
Yeah, and then that's just Amex, when they gave their latest, actually increased the provisions quite significantly for upcoming bad and doubtful debts, which I think is a very important leading indicator.
Yeah, absolutely. And we're talking a little bit about the Aussie case there, where we've started to see a tick up in insolvencies in Australia. Still not at sort of dire levels or anything like that, but they're certainly well above the sort of COVID lows we've seen over the last couple of years, and getting back to more sort of what you'd think is a more normal. And that's that. There's plenty of different forward indicators that are sort of showing that that they look like there could easily be problems. And so the question really is, are these ones giving us all a bump steer, or should the banks starting to be provisioned, or typically they'll tend to wait a bit longer. So wait till they actually sort of really see the
well, they're still optimistic, right? Basically, I think that's the way I read it. But it is quite interesting. And of course, the other big factor, which is there, if you think that the US market is sort of still wobbly, and by the way, it's pretty skittish, right? So it tends to run up and down on very slight news. So
we had a 5% turnaround in one day where we fell.
Yeah, that was the day we've had more big moves than we've ever had, I think, if I look back at the statistics.
Yeah, and one of those days where it was down 2.5% and then rallied 2.5%.
Yeah,
so the net, you're like, oh, it didn't change much, but you're like, no, inside the day it was, yeah.
And there's two observations. One is there's a lot of algo-driven stuff going on, right? Because as the markets move that amount, the algos kick in, and that then reinforces the down or the up, right? And so that's something that's worth thinking about in terms of, a lot of it's being done by computer. And then the second point is that, you only need a Fed chair to come out and say, yeah, we're going to stick to our guns, or a Fed chair to come out and say, oh, we might give it a little bit of a sort of a, more relaxing view, and then the market say, whoa, whoopee, or not, right? So it
feels we had before was really like, oh, well, maybe we won't do 75 basis points, maybe it's only 50. So like, happy days, it's like, oh, no, that's still going up.
Yeah. And the other observation, of course, it takes a lot longer for everything to work through than people think, right? So the markets are trying to form a view based on very little current information, right? So, it's what happened back then. I mean, look at the inflation numbers. The inflation numbers are still, quite bad.
Well, that's and it's probably a good place to start. Maybe is what can go wrong.
Yeah, let's do that.
That's sort of one that I'm certainly looking at. And so, the first place I always start with any of these big macro terms is the US consumer, because that was where in most crises that you generally see this sort of blow up in terms of the household debt service payments, and that's what I've sort of got up here, and you can see that that line pre the financial crisis in 2008, it hit sort of over 13% of disposable personal income, and the prior crisis it had this big run up as well in before the tech boom, and maybe it wasn't quite as well timed in the 1990s, but certainly you saw the run up as well before getting that. And this time it's what's stark is it's just not there at all. Like yes, there's been a run up from COVID lows, but that was like 30-year lows or 40-year lows, so it's not like it's at any sort of dangerous level. So that's the US consumer, and then you sort of go into US corporates, and it's pretty much the same story for US corporates. So contrasting this one, 1990 was more about a corporate blow up in terms of the US, and so you can see that big run up in terms of this is what I'm showing here is the net interest versus GDP. Net interest for non-financial corporations, and then. Again, right now it's plumbing the sort of the 40-year lows there. Now it is a lagging measure. So when corporates do borrowing, particularly if they're going to tap sort of public debt markets, it will be on a sort of 3-year or a 5-year sort of basis. And so their average loan profile, they're not going to see the rate rises for some time. But again, it's really not looking like the US corporates are in any sort of major issue there. The place where you do notice it is in inventories, and I've spoken a few times here about this whole idea of this inventory super cycle that we're going through, and so it's a little bit technical, but I've got a bunch of different ones showing up here, and it's the same across the US as well. I just sort of showing a few countries in Europe as well, just to show the same trend. And what this one's measuring is if you do surveys of companies, and then you look at what they're saying for the new orders, and then subtract what they're saying for inventories, with the idea that if your inventories are full and you're not getting new orders, then things are going to be even worse than because you're going to have to run down your inventory as well. And so we're in one of these sharp spike down lines there, and it's looked upon as a bit of a forward indicator of where things are going to go. And so that's certainly one area where we could see a blow up is companies, and we've seen a number of US stocks already come out with warnings where they're inventory is too high, we're going to have to cut and things like that. But the issue with inventories is this isn't like they don't create financial crises usually, like on their own. Like in inventories, this is just like a normal business cycle. This isn't like a big financial crisis that causes a recession type end of cycle event. And so, so inventories are sort of an interesting place to keep an eye on because it does look like there's going to be some things going on in inventory, especially since all the problems we had with inventories over the last few years, and now all the orders are finally getting through, and that seems to be largely unstuck. That companies are probably over ordered, and then we'll sort of go back to more normal levels. So that's another place, and then you go. So that's the US and European or sort of global corporates. Then you start looking through and going, well, can things go wrong in terms of governments? And you go, yeah, absolutely. Emerging markets are probably your most likely place of getting blow-ups there. So, I've seen a few sort of wobbles in places like Argentina and Turkey and Sri Lanka, but none of those are big enough to blow the world up itself. But you've got to be worried about every time you see the Aussie dollar, sorry, not the Aussie dollar, the US dollar running so strong, that can create emerging market crises.
And the IMF was calling that out specifically in their recent Washington meetings, right? Which was basically saying that the strength of the US dollar is creating havoc in some of those emerging market areas.
Yeah, and then you get the weakness in the yuan as well.
Yep.
Causes the same. Also causes different problems in that they're often then competing with goods out of China. So that's creating issues. And then can
I just pause? There's a couple of questions come in which I just want to cover before we get too far down the road. So this one came in from Smooth, and thank you very much for the super chat and for the early one too, Smooth. Really appreciate it. Does Damien think the market will go down all the way to next October, so October Tech 23, before it crashes, or do you think it will crash sooner than that? So he's assuming a crash is coming. It's a question of when.
When. This is for the stock market, I'm assuming. Yeah. So look, I mean, I don't know when it's going to come. That's always a tough part with these ones. You can sort of see markets and you go, they're overvalued, and they can be overvalued for a year or more longer than what you expect.
Yeah.
I would say the next leg down. So we're already a fair way down this. So if you're buying today rather than 6 months ago, you're obviously doing a lot better. But I would say that there's most likely to be another leg down from earnings. As we see earnings downgrades come through, and as we start to see, the things I was talking about with inventories slow up, and the demand effect of all these interest rate rises, because I think you need to say, from my perspective, I need to go, well, central banks have promised us they're going to bring down inflation, and they look like they are. If what they've done so far isn't enough, and I think it probably is enough and potentially too much, but it seems like they're going to keep going anyway until something breaks. They're going to keep hiking until something breaks, and so that's what I'm sort of waiting for, is something break, and then trying to assess where's a reasonable level that you'd be happy to buy in at regardless.
And the point is that what may break may not be the obvious thing. Right?
No. Well, take the UK as an example.
Yeah.
I was about to say, I've got my bingo card of, could it be, or you looked at, say, Credit Suisse, could it be an investment bank blowing up, money that didn't know if it had taken risks it didn't know? Yeah, absolutely. I've got that on my bingo card. Emerging markets, yep. I mean, I even had some European, maybe, you start getting some problems with Italy and Portugal and Greece and, some of these other ones we had last time in the European crisis. But I wasn't expecting the UK to sort of, all of a sudden, the debt market there to freeze up and the government to come out with quite wild.
And the interesting thing about the UK, of course, because it was the £1 trillion long-dated pension sector that was hit, right? Because they basically were on margin calls, right? Because they were trying to leverage returns. It's something that a lot of people hadn't understood. And it's interesting that the Bank of England is now having conversations with hedge funds and pension funds in the UK to try and understand what their leverage risk position actually is.
Yeah. So, I mean, they'll all argue that it's a liquidity, not a solvency issue.
Of course. But they will say that, wouldn't they?
Exactly. That's always that's when somebody makes that argument, sometimes they're absolutely right, but sometimes they're also absolutely wrong, but that's the first argument they make. And so, I mean, the issue, I must admit, the one I don't particularly, well, I don't want to say I don't understand it. I understand it. I don't particularly buy the argument. Let me put it that way. Is the whole risk parity trade, and that's a very big trade. And what effectively this is it's a Bridgewater, and Bridgewater's like world's largest hedge fund, and Ray Dalio sort of started it, and it's been a strategy they've run in quite successfully for decades. But the idea effectively is that bonds are less volatile than equities. And so, therefore, what you can do is when you're running your portfolio, you can basically borrow against your bonds to increase the leverage of your and increase the volatility of the bond part. So it's the same as the volatility of the equity part.
Yep.
And it's risk parity. So now I'm taking the same amount of risk, but I've borrowed behind the bonds to increase risk. Now that's you can follow through the arguments and you can get some of these great arguments, but I can't help but think every time I go through the part is that this sounds awfully like a margin loan. It's just a margin loan over the bond part of my portfolio rather than the equity part, because I started with a 60-40 portfolio of 60% equities and 40% bonds. And now I've got a 60-40 portfolio with a margin loan effectively behind it. So, anyway, that's...
No, I think you make a really important point, because these things are often dressed up as though they're somehow very different. But the same basic principles.
It's risk parity, Martin. It's not a margin loan.
No, exactly right. I mean, if you go back to the securitization problems around the global financial crisis and all of those other advanced quote unquote derivative programs that were put around, but it was the same basic problem, right? I sometimes have to keep reminding people that actually this investment merchant banking stuff, it's not complicated, right? They just have very long titles and new names.
Yeah, they just make it seem complicated. Yes,
exactly.
In order to charge more fees.
Earn their university degrees and mathematical degrees and what have you, and they're very large salaries. But the fact is, it's quite true, and that's the point. That the risk profiles that people assume to be in those situations were proved not to be actually what the risk profile was. And that was the real thing that went wrong.
Yeah, and also it's the Minsky argument that basically when you've got quite stable assets, then the way humans are is they'll leverage it up until it's too leveraged.
Yep.
And the longer it's stable, the more they'll leverage, and so until when it does blow up, it's like, oh my goodness, I didn't know that. I didn't know that could happen. Yeah,
you keep going until you make a mistake, and then it's a bigger mistake because it's.
And then you try and wind back, but
gone
everyone
down
else has done it.
Yeah. So the UK is a really interesting, and just dwelling on that for a second, fascinating to me that essentially the markets were able to dictate political policy.
Yeah, absolutely.
Just think about that. Absolutely. Basically the market said we don't like this. And they changed the prime minister.
Yeah, wow. That's right. It's we don't like this, and it could have been, absent the Bank of England stepping in, there could have been a genuine financial crisis coming out of it.
Yep.
And for we were joking just beforehand that this is a classic emerging market debt crisis, with the punchline being that the UK is not an emerging market.
No,
or yet at least it's a. Yeah, it's.
I was listening to somebody yesterday actually talking about the UK and arguing that actually there are a number of significant cracks now in the economy post Brexit, and if they're not careful, they're going to end up with a low growth, no growth environment with higher taxes and not enough money to sort of service it all, which is precisely that emerging market debt spiral. And they predicted that within 15 years, the IMF will have to be chucking another load of money again to try and save the British economy again.
Yeah. So and so the positive part of this is, okay, somebody comes up with a really wacky policy. Let's just give lots of money to rich people and worry about the consequences later. And so that, from that perspective, I'm like, okay, well, that's positive in terms of that. But the negative part is, there's sort of this consensus about this is the right way to run an economy, and in a way, it's it is helpful to have some countries doing some things and other countries doing different things, and that's my only concern with it. Is this a it's good in that hopefully it's stopping people from saying, oh, that trickle down stuff is going to work if we just do more of it. But the flip side is, I hope that doesn't mean that everyone's sort of going to sit here. Every country is going to feel like, we have to be completely orthodox in our approach, and we can't do anything different because we're too scared of markets to do anything. So.
But you see, the interesting thing is, if you think through the last 20 years, right, we had effectively, let's cut interest rates and do quantitative easing, and pretty much all that became orthodoxy, right? All central banks in more Western economies did the same thing, right? And then it started to sort of wobble a bit, and then they've gone on to sort of plan B, which is, right, now we need to fight inflation and lift rates. There's really very little independent thinking. Right?
No.
And everybody is dancing the same tune. Yeah.
It's part of that.
Yeah. And that worries me a little bit, insofar that, of course, a lot of that comes through down from the central planning, from the BIS and from the IMF and from the World Economic Forum and all those, that top-down stuff. And I wonder to what extent local differences in local economies would fade into insignificance. Everybody dances the same tune, and it's almost...
Like, for example, the Australian economy's got way more debt and floating rates versus the US.
That's where I was heading, right? So, the sort of the rate rises we've had in Australia because of our massive debt leverage is putting a much bigger brake on the economy compared with, say, the US. And yet,
absolutely,
we're sort of caught in that RBA, I've got to put the rates up, I've got to get inflation under control.
Yeah, I want to be the same as everyone else. Everyone else is doing it. Yeah, I guess I should as well. Yeah. And the other part, from a philosophical point of view as well, is that I wonder, in a way, is this sort of the natural evolution of central banks, and it's sort of brought the system to the stage where. Actually, let me take a step back before I explain, because there's a slightly complicated story, but it's basically going, okay, well, 30 years ago or 40 years ago, monetary policy and fiscal policy was part of the government. So the government was in charge of both. They needed to make sure that they could pull on one lever or the other lever and all, at the right time. And then we went through that whole decision as, oh no, actually, you know what? We never raise rates high enough when things are going great. We need someone independent to do that. And so then the independent central banks. And then you sort of end up with what the Australian government was doing there for ages, which was they're trying to run budget surpluses for, I don't know, advertising purposes, and basically going, the economy is the RBA's problem. Like that's not really my problem. And so we're running fiscal policy at complete odds to the monetary policy, and in a way, I sort of felt as if what was happening in England was the natural evolution of that in the UK, in that they're just gone to a complete extreme in terms of those basically going, and in a way, it was sort of like a bit, it wasn't for the markets revolting from it. You can see from a political point of view, it's like, well, let's give this a shot. And you know what? If inflation goes out of control, then we'll blame the central bank for not hiking rates enough. And if we crash, if we don't and it doesn't get enough, then we'll just blame the central bank anyway. And we're running huge. It's like it's almost as if what we're doing as government no longer matters because somebody else is looking after the economy. We can be Santa Claus and keep handing out presents all the time.
Well, I think that's a very important point. Whose problem is it anyway, right? Everybody says it's their problem, right? But it's interesting if you look at what's happening in the US. There's now a debate about whether the Treasury should actually be more proactive. So if you look at some of Yellen's recent comments, right, it's almost as if she's almost positioning to create another sort of central bank type entity that can do some of the things that the central bank can do. So they can look after.
She might have done if she was in charge.
Yeah, well, exactly right. And there's this thing called Operation Twist, which is basically where you buy and sell bonds at different ends of the spectrum, right? That could create a whole pool of liquidity that you could then go throw at the economy, which means you don't necessarily need to worry too much about, quantitative tightening. And you can put interest rates up, that's fine, but we're going to do some other stuff too. It's almost like, well, hang on a moment, who's actually in charge now? And does that actually question the relationship between the central bank and Treasury, and how connected and disconnected are they? And in Australia, of course, there's an interesting question about whether the RBA and Treasury actually are really just two sides of the same coin, just with a bit of a dotted line down the middle.
Well, and which I don't have a problem with, but I just like it to be somebody take responsibility.
Correct. That's the key point.
Exactly. When everything goes wrong, it goes, oh, well, that was the other guy.
And when the RBA can turn around and say, well, actually, we don't think there's going to be much in the way of house price falls, and then a few months later they update their model and say, oh, it might be 11%, and now they've updated their model and now it's going to be 22%, right? So, who's taking responsibility? Well, at the moment, neither APRA nor RBA claims to have any responsibility.
And you don't think the government wants to step in and claim responsibility for falling house prices?
No. I don't think they do. And in fact, they're going to throw $1 billion in to build more houses through the superannuation system, and they're going to help through the states to get more people to get shared equity. Everyone's, suddenly they're realising that, prices could fall a lot more than people think. That could be a problem.
Okay. So, and here we have this. There's a cognitive dissonance here, isn't there? I don't want house prices to fall, so I'm going to go and build a whole bunch of extra houses.
Yes.
But at the same time, you're like, well, yeah, but I do need rents to get down because rents are out of control.
Yeah.
And you're like, well, okay, so rents are out of control and we've got really low vacancy rates. So why are we bringing in a record number of people?
Yes.
Like it's sort of like there's a cognitive dissonance in that.
Migration is the problem, not the solution. And yet migration is a problem that is looking for another solution, like we haven't got enough workers at the right price point.
Yeah, and I want to be clear as well. Like I do think migration is a great thing, but there's an issue about saying, would I like to bring, say, 10 million people per annum into Australia? And I go, no, that's too many. And then I go, would I like to be zero? No, that's not enough. And the answer is, somewhere in between. But it's a matter of actually thinking about where it is. Whereas I think there's a general process at the moment, which is the more immigration, the better. Is sort of, I think, embedded into a number of processes. And it's like, well, no, that's not the case. There is a limit to, and I think if you speak to the people, they do, I mean, in my experience, the ones who do push that whole, no, you need more immigration, the better. And you're like, okay, well, let's make it 10 million people a year. We'll get a fleet of ships to sail around the world and go to poor countries and bring people back. And they're like, no, that wouldn't work. And you're like, well, just a minute, is it? So we are on the same side. We're both saying that you can have too much. It's just a question of when. And then, and also there's obviously the federal versus state thing where you get to go, the feds get to bring everyone in and then go, oh, more tax revenue for me and more costs for the states. So great, it's a win. It's a win-win for the feds without having to pay the cost.
And the point about that is, of course, there's a different answer if you actually have the supporting planning processes and integration processes, right? So that effectively you don't suddenly flood a particular part of the country with people without everything else, like all the other infrastructure in place.
Yeah. So actually having houses before they get here, rather than
novel
saying,
idea, hey?
Let's flood the market and then build houses over the next 5 years to house the people we're going to bring in over this.
And we won't have enough water, we won't have enough power, and food might be a problem. But we'll muddle through. Well, no, it's actually reverse order, right? So let's lay the foundations, and then you can figure. But that seems to me to be too joined up thinking.
Yeah, that's right. And there is an interesting part. There's a couple of economists who've written papers up, sort of talking about the whole, what comes first, chicken and the egg, in terms of population growth, and so there's an argument that basically says, well, when you actually slow your population growth, it actually means that the people running a government can then focus on how do I deliver better services and how do I do, improve productivity. Whereas when you're flooding the market with too many people, all they're doing is running around going, oh, I've got to build another school, I've got to build another hospital, I've got to build I've got more people coming in, I've got to do this, and more roads, and so they don't have time to actually make better the better decisions that then increases the productivity.
And make the other point, of course, is unemployment is so low because migration was so low.
Yes.
And as unemployment, it's going to go up as migration goes up. It's a natural corollary. And wages growth will stay low because wages growth is also somewhat connected, isn't it?
Yes, absolutely. Now, actually, is that a good time for this inflation?
Just before I get there, I've got just one other question from Jason, and thanks for the super chat, Jason. I really appreciate that. We haven't seen the beginning of the domino effect of zombie businesses that were propped up solely on stimulus falling over yet, have we? When do you both think that will evolve? or can it be kicked down the road again? I think that's a really important question.
I have some anecdotal evidence of these, but I feel like it's soon, but I don't know is the answer. So, and I guess like I'm looking at ones where a gym around the corner from our office the other day closed down. Finally, they were, COVID hit. They got all the handouts. They got all the different transfers. They came back. Everything's running at 50%. And eventually, they've given up and gone, okay, well, it's enough. But this is, obviously years in, and there's plenty of restaurants that I can point to, sort of all doing that same thing. And we've, very much noticed in Melbourne, sort of the western end of Melbourne, there's just shops everywhere that are empty, and the more lived part in sort of central and in the CBD, Western Melbourne CBD, and that whereas more the place where you have more people living, it's not the same issue. But you can obviously see there's that part where somebody owns a shop. When COVID hit, they left, so they're losing 50 grand, say in not having anyone not having that place tenanted. But actually, it didn't really matter at the time because I lost 50 grand on that, but I just made 100 grand because interest rates are so low, the value of my property went up. And the same thing happened again the next year. But now that's not the case. Now it's going the other way. And so I do think it's going to start hitting now. But do I have evidence of that? There's a little bit in insolvencies starting to tick up, but it's not at anything you'd say is a terrible level. But I do feel like we're hitting that point. But now I'm looking for evidence to try and back it up. So, sorry, Martin, I've lost you on sound.
Sorry, I muted it because the dogs have been barking at the possums.
Yeah, right.
I may need to go and shut the door if they keep barking. So the possums are very active tonight because it's so warm, and they're jumping from tree to tree to tree, and the dogs can hear them going squeak, 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 and they don't want to go and chase them. So,
well, next time I get on my soapbox, it'll give you 5 minutes to run around.
Yeah, exactly right. So when you start talking about inflation, I'll go and shut the door. The point I was making was that the SME surveys that I run, I have a set of questions in there about financial conditions, and I am seeing an uptick in those businesses that are saying they're really struggling now with cash flow, and specifically with the need to pay the ATO. Do you remember that there was some relief over the last couple of years?
Yep.
As well as the stimulus, there was some relief in terms of what they actually had to do. Well, that's gone now. So in fact,
and we've just gone to the monthly payments now as well for smaller companies.
Exactly right. So that's actually one of the key drivers is the cash flow fallout from some of those reversals, and they also reversed the insolvency protection that was in for quite a long period of time. Now, I also had a conversation the other day with an insolvency practitioner who said they pretty much went on holiday for 18 months because there was nothing happening, right? And they're now as busy as they've ever been.
Right.
Which suggests to me that we've now started to see this cycle begin to turn, and probably over the next few months, and particularly perhaps into the new year, we're going to see issues.
That's it.
Interestingly also, that things like the floods and the bad weather is putting huge pressure on, for example, some of the farming communities, because a lot of those were actually expecting to do very well this year with, significant crops. Suddenly those crops have been knocked over completely, and the compensation is a lot lower than the value of the crops would have been. Yeah. So, there are a few cracks appearing. So, but my own sense, it's going to take a bit longer. And then the other part of it is if you go up the scale into bigger companies, how many zombie companies are there? Well, we know that quite a few of them have got a lot of debt, and we know that the cost of debt is going up. But it's probably got a bit of time to work through before we really know how bad it is.
Yeah, and my guess would be, actually, I was about to guess how many years, what the average tenor of the debt is. I must admit, I haven't seen that for ages, but I would guess 3
to 4.
Oh, good. Okay, I was going to guess at least 3.
Yep.
Yeah. So, in terms of fixed rate, is that what you're talking about? Yeah. Okay. So they're where are we? So 2022. So we're waiting to 2025 to really start seeing it'll gradually tick over.
It'll roll over because, of course, it's a continuous issuance. But Yeah.
But your full effect is not of the rate rises that happened at the start of this year aren't happening until mid to 2025.
That's exactly right. So some of that's going to come through. So I remember I said earlier on, it all happens slowly. I think that's the point to bear in mind. This all does happen much more slowly than people think. It's not going to sort of blow up tomorrow afternoon, but it's a slow grind.
Well, and when you say not blow up tomorrow afternoon, and the danger is one of these things does blow up tomorrow afternoon. The UK market does it.
Yeah.
And then,
well, it's a good example.
They go, and then, but luckily the central bank steps in and they go, that's all right. And then you go, what's the next? And I do think at the moment, I said, we spoke about Credit Suisse having problems, and the price of covering its debt and all that type of stuff. I think given the fact that last time the whole financial crisis was kicked off by Lehman Brothers falling over and deciding not to rescue it, I do think this time central banks are probably going to err on the side of. So it might be an investment bank, but then again, it's likely to be an investment bank to have a blow up, and then central banks step in and convince other people to buy it or back it out or whatever, so what's going to cause it this time will be something
different.
Something different, yeah.
No, I agree, absolutely. And there was this one other question before I let you go loose on inflation. This is from Smooth saying, keep on dancing, keep on printing central banks and everything will be fine, never mind the debt. When does Damien think the debt will be too big?
Look, if you can print, I'm not particularly concerned. If you're a country that owns a printer and most of your debt is denominated in your own currency, then I'm not that concerned about how much debt you have. I think the problem will come. Let's say you are a country. Say the UK decides that it's going to go down, a path of spending lots of money and giving tax breaks and all that type of stuff like that. You go down the trust route. I think what will happen is more and more companies within that country will find that they can't borrow in pounds anymore. They have to borrow in US dollars or something like that. And so the effect of that would take a long time. You can get problems like in Europe where you've got one group of countries, they're sort of all locked into the same currency and they can't print. And so one group of countries might be, say Italy or something like that, might have more debt, and other groups of countries might have problems with the policies that are being run there, and that whole that's how that whole European crisis sort of evolved last time. So I can see those problems. I think in the way, and I guess the question with the whole debts thing is okay, well, what does that actually mean for Australia? I mean, in the end, the question, let's say we're talking about Australia going into too much debt. There's sort of two different types of debt you can go into. One type is you can go around and promise everyone, hey, Martin, you're going to have a pension, you're going to get healthcare for the rest of your life, and the pension's going to be really good, but we're not actually going to put it on our books. And so you're effectively in debt as a government and as citizens. We'll pay taxes to all these people, but we don't actually explicitly see that because it's a promise that's been made that says that governments purposely haven't sort of put onto their books as to what the liability is. And then there's the part about going, okay, well, what happens if I'm, say, the Japanese government and I'm borrowing money from my own citizens effectively to go out and spend it on other things? Well, effectively what you're doing is you're repressing those. You're basically saying to your richer citizens who are lending you the money, I'm going to give you really bad returns over the next few years. Instead of charging you more in tax, why don't you give me your money and I'll just give you really bad returns on it? And that's sort of where, I guess, in the way that the Japan sort of ends up in that, and it's also the Japan as well, where it's the government's issuing debt on one hand, and then the central bank's buying it on the other. And we spoke about that independence part, but I think the total amount of Japanese debt sort of, I lost track, 250%, call it, could be high by now, but the net amount of debt once you cancel out all the central bank ones is like 70. And so, so there's just ways you can do around that. But I think effectively what you're doing is giving investors lower returns rather than taxing them.
Now, that's interesting. And by the way, on Japan, it's interesting. The 2-year Japan bond is just knocking on the door of zero now. And it could well be that the announcement from the Japanese central bank this week will be that they will just tweak it slightly to allow it to go positive, which will be the last essence of negative interest rates in global bonds.
We've been kicking around the idea that so just put this in perspective for everyone, the Japanese central bank has been very much on the case of no, they haven't fixed inflation there, that they need to keep rates low and they need to keep printing money and all that sort of thing. And they're right so far.
3%, right?
3%, yep. But of that 3%, most of it's energy and food,
yep.
which doesn't get affected by higher interest rates. And so we've been talking about when the Japan central bank flipping to raising rates or stopping that we think that would be very much an end of cycle or end of that's probably the last rate rise we see, and then we're back into printing money. That's the last one to fall. But yes,
absolutely. Anyway. Well, it might be soon. Kuroda actually finishes his post. I think it's next April.
Right.
So some people are suggesting that they might actually hang on with the negative setting they've got. It's just under zero at the moment in terms of the cash rate until next year. But then potentially that could be an interesting break point, as you say. It could be actually when things begin to swing. So, but it is interesting, and it's interesting. I think it's something like $1 trillion US of bonds around the world are in negative return territory, right? So paying a negative coupon. Worse, it was 18 trillion.
Yes,
it's quite interesting. Just thinking about how much that's changed.
Yeah, and from on an inflation adjusted basis, obviously there's inflation is now much higher. So on a real basis, almost every bond's.
Yeah, absolutely. Now let's get on and talk about inflation, because you've got some charts which are actually fascinating.
Yeah, so just wanted to highlight reported inflation. So there's two things we need to keep in mind. One is what's the CPI going to be and the PCE in the US, which is sort of their preferred measure. But what are the actual headline numbers going to be, and then what's really going on underneath? And so I'm just using actually this one. I'm just sort of saying, look, it looks like the October number is going to come in at about 0.8. Maybe it'll change between now and sort of next month. But the figures at the moment, there's a sort of a nowcast that one of the Cleveland Fed sort of does, which is but at this stage it's probably relatively accurate, but it means we're basically there's not a lot of respite coming this month. Now, let's say all those things we spoke about before all happen in November. So, sorry, excuse me for a sec. And so we go to deflation, negative 5% per annum, so quite deep deflation, and a big recession. So starting on the 1st of November in whatever it is, 2 weeks time. If that happened, then because of the way inflation's evolved, and I've got a chart up there, hopefully sort of showing it, is that when we're sitting in March, inflation will still be, or in February, inflation will still be well above 2%. Like sort of be like around 3 or something like that. And right throughout that period, like you could be just going November negative, December negative, and we've been pretty flat for a few months as well, this next one. But you can sort of go November, December, January, February, all these negative prints of like showing that the economy is in deflation, and still the headline annual deflation is going to be 3 or 4%. And what I guess I'm saying is that's going to put the central bank in this quandary of going, let's say they do think they've done too much and they've crashed the economy, they're not going to be able to reverse at that point, or they're not going to be able to, it'd be very hard for them to turn around and say, oh, now we're starting to cut rates if they thought they'd gone too far, because they're still going to have these really high headline numbers. And it's not until middle of the year that you'd actually be able to get it. And now keeping in mind, that's a negative 5%. Now that's a pretty extreme scenario. It's more likely to be, somewhere between that and what we are now. But I guess the main thing is it's not until March that you're going to get that sort of steep part of that curve is going to sort of come out of the numbers, or start coming out of the numbers. And it's not really until June that you've got a chance that. I think I've got another one that sort of says, oh, what happens if current settings were just perfect and you go to like 2% per annum? Is that these high annual figures are just going to keep printing, and so the Fed's going to keep likelihood is they're going to do too much just because of the shape of the curve.
And is that so? There's a lag question, isn't there? How long it takes, right?
Yeah,
I think the RBA and the Fed both said 18 months to see the full effect of the rate rises that they've already done.
Yes.
Just pause on that. 18 months, right? Over what period have they been lifting rates? Well, 6 months, 7 months, right?
6, yeah.
So they can't possibly know.
No, that's right. But if you're the Fed turning around or you're on the Fed and you absolutely knew you'd done too much and you'd crashed the economy, and you're sitting in January next year or February next year, and you're going, I have headline annual inflation or even headline core annual inflation of 3.5% or 4%, and I want to tell people it's time to start cutting rates because we've done too much. Yeah, it's not going to happen. And I guess what I'm saying is that's the chance of an accident now, given the shape of it, just seems higher than.
The implication is interesting. So you can still potentially have inflation above target, but be in a deflation environment.
Well, annual inflation.
Yeah.
So I guess this is a part. If you looked at the 3-month average, a 3-month average, you're running at big deflationary numbers.
Yeah.
And so that's where, I guess what I'm saying is the Fed will be able to look at this and say, yes, we know we've done too much, but the average politician and the average, Fox News host is going to be looking at headline numbers and saying, the headline is 4%. You cannot possibly, and maybe there'll be people in the bond markets and stuff like that. It'll be the same, How can we trust you if we've got headline inflation of 4% and you're flipping around?
Yes.
So, and I know that, there's a number of the Fed people have come out and said they have to kill inflation. They have to make sure it's dead, yes, because the lesson they learned from the 1970s was if you don't kill it properly and stomp on the corpse, it'll rise up and come get you.
Volcker is the model, isn't it?
Yes, exactly. He was a hero, and so I would like to be a hero as well. And so, keep raising. So I think the chance of an accident, or the probability of an accident, just keeps growing.
And just to explain the accident, there's an accident in the US potentially, but more importantly, as we said earlier on, lifting rates in the US, the spillover effect in terms of exchange rates is really where the accidents are likely to, whether it's oil or whether it's emerging markets or pressure in other economies or China or whatever, right? So the problem we've got is that, of course, the US wants to keep the dollar as the reserve currency.
Yep.
Well, they actually don't mind a particularly strong dollar.
No, but strong dollar generally causes problems for emerging markets.
Yes.
And then the other problem we spoke about as well is that, and the reason why there's a couple of different reasons, but one of the main reasons is that often they have debt denominated in US dollars. So they go from, I have $100 of debt today, and then my currency falls 20%. All of a sudden I've got $120 of debt. It's still $100 of US debt, but now it's $120 of my debt that I have to pay. And I'm earning less because my currency is worth less. So I'm earning less and I've got to pay more.
Yes.
And so you end up in that crisis from that perspective. And then at the same time, if you have China doing what it's doing, devaluing the currency, all of a sudden, not only have I got a higher debt and I'm earning less on all my money, but all of a sudden China's devaluing its currency and trying to export into my markets, and I can't sell because they're undercutting me on price.
Absolutely. And of course, Australia potentially will be exposed in that scenario, right? So particularly if the RBA doesn't lift rates as high as, say, the US, the exchange rate will drop further. And that means we're going to import inflation. And whilst that might make our goods cheaper for export purposes, it creates a whole lot of internal problems. Yeah. I sort of, in a way, I don't care about those problems as much, and I'm hoping the RBA. I mean, they say they look through it, but I think the reality is they probably don't as much as they should. But it's the idea, if the currency falls 10% and all my goods get 10% more expensive, okay, that is inflation, but it's pretty temporary inflation unless my currency falls 10% again next year, and 10% again the year after. So as
a one-off hit, I'm like, that's fine as long as you've got a workforce that can then, you don't know. Well, I guess you want to be able to have a workforce that can, when you get more demand, actually has capacity to go and do it. Whereas that was where, when the mining boom was on, we just didn't have enough workers that without jacking wages. Right now, it would be nice to see some wage growth. So, yeah, I
think the budget is saying no wages growth for at least the next couple of years in real terms.
Yeah, I know. But what's how like, and it's underreported, isn't it? That's basically saying, "Oh, hi, Martin. Thanks for living in Australia.
Yes.
Your wages are going to go backwards for the next few years, but thanks for your vote and vote again for me next time."
What they should be saying is, please open your wallet and say, "Help yourself."
Yeah,
because that's basically what they're doing, right? So the value, the value of your dollar is actually being reduced.
Yes, absolutely.
Yeah,
and so
that's the bottom line, unfortunately. I just wanted to share this one with you. So this is from Michael. They met you, Damien, last week at the seminar and enjoyed that. Do you see a short-term rise in GBP with a new change in the UK PM? I suspect more stable policy ahead. I think that's probably right. The pound's definitely, because it dropped close to parity at one stage, right now it's back to 113, 114. And presumably the expectation is that Rishi will be a steady hand, although who knows quite. But anyway, I just wanted to just reflect on, firstly, the seminar last week, and then secondly, maybe just touch briefly on that issue about the pound. So look, thanks for everyone who came along to the seminar. I think there's, we spoke a lot. I think the difference was we spoke a lot more about the longer term sort of outlook for some of these. It's as you're probably well aware, I could easily fill an hour talking about the latest events and what it means and the short term impacts. But it was really just sort of taking that step back and trying to look at longer term. Where are we looking at for portfolios and what are we expecting? What's our playbook for how to deal with it? Sorry, what was the second question? Second question was just the pound. The pound, yeah.
Yeah, look, the UK has problems. So, the main thing they've got to try and sort out now is the whole. Yes, they're Brexited, but what are they've had the party.
They haven't capitalised on.
They haven't cleaned up.
No, exactly. There's thousands and thousands and thousands of lines of legislation, which Rishi a few months ago said we'll clear out and get it back to British instead, right? None of that's been done yet, right? So they're clagged with all of the Euro stuff that they were trying to get out of. They also, of course, have got massive trade issues because, of course, the Eurozone was their major trading partner, and guess what? That's not now working quite as well. And they've got a much more complex supply chain between the UK and Europe. And of course, they've got the Irish question as well. So a lot of the
and let's add some more. They've got because they're so close to Europe, they've got energy prices that are out of control.
Yes.
And they don't have and they're sort of reliant on wind power and a little bit of nuclear.
Well, they're actually reliant on some power coming across the channel.
Yeah. So there's problems there. What was the other one? Wages. Wage growth is really high and inflation is really high.
Exactly.
So, if you look around the world, I sort of typified as saying, well, the US and the UK both have high wage growth, high inflation.
Yep.
Everywhere else doesn't. You sort of go, there's a number of places with moderate wage growth and inflation. So Europe, Canada, a lot of other, well, most of Europe, but even when you dig into that as well, the way the Europe's wage growth has gone, most of the big countries have quite low wage growth. The big one is Germany in terms of its sort of, I think 4% and a bit maybe. But it's the way it's done it is largely as bonuses. And so, you're working in a German factory somewhere and earning whatever 60,000 euros. And what they've done is that rather than say, things are tough, lots of inflation, here's, you were earning 60, now you're earning 65. What they've done instead is they've said, here's a $5,000 bonus for this year, but you're still on 60. And so, so with the view that, so it helps wage inflation, but it's not embedded wage inflation, I guess. And so that's the part where if we are going to get this inflation spiral, you need that wage growth really to kick through. And so, so anyway, so I sort of got sidetracked there, but I guess what I'm saying is UK's got lots of other problems. It does have a genuine inflation and a genuine wage push you there as well. So
absolutely, and it's interesting because the Bank of England was forecasting inflation 12 to 14% at one stage. The gas price has come back a little bit. So it got up to over 300. Now it's down to about 100. Typically, it was between 5 and 30 previously. So it's still quite extended. But the other issue is they're still worrying about whether they've got enough electricity for the winter.
Yes. So this winter is going to be interesting. Well, I don't want to call it interesting. Is probably understating
we hope
because
it will not be a cold winter.
Yeah, exactly. Yeah. And it's the point of maximum pain though as well. And you think of as so Europe really only had 6 months to try and sort out their as much replacement for the Russian gas as they could. And so they've had that sort of 6 month window and running around trying to do as much as they can. Once they've had 18 months, they would have been able to do a hell of a lot more. There'll be all these extra floating platforms so that gas can come from the US and more stuff diverted from Asia. There'll be more renewables on. There'll be more old plants that are restarted, whether they're nuclear or maybe some coal ones that are restarting. And so 18 months is enough time to sort of that next winter, even if it was a cold winter, they'll be in a much better position for it. So, this coming one though that we're about to hit in the next few months, if it does look like it's going to be mild, but if it's not, then those energy prices, who knows where they could go? They're much higher.
Absolutely right. Yeah. Well, we should move the conversation on because there's an important conversation we had about China as well, right? So China this week reported GDP relatively low. Xi got emporized, or whatever the right word is, for being the person in charge for as long as you want. He put a new team in place, which were basically more about people who supported him rather than capabilities and skills, seemed to me. And a couple of the old guard were tapped on the shoulder and taken out. Yeah,
I know. And well, actually, it's obviously sending a message, an interesting message to people there. Yeah. And I think there's that, we saw the Chinese stock market fall quite significantly. With, I think this is the next round of people who have finally sort of realised that actually he's not going to change. It's not like he was just waiting for the next party congress and then he was going to open it up and it'd be great to be a capitalist again. It's they're giving up on that. It's
embedded. The new doctrine is pretty much same old. COVID will still be zero. Looks as though they're still wanting to compress the property sector and deal with that. And that's overall growth quite low.
I've got some of those charts up on the property sector, actually. That's so what I do is they report a bit weirdly. I do like a rolling 12 months of floor space started. And so you can see on this one, they've basically, in 2007, I can't forget the guy's name. I think it was Wen. There was a premier who basically said we're unbalanced and the whole economy is got way too much property and we need to rebalance the economy. Since then, they doubled the amount of property into the sort of 2012, 2014. Then they pulled back and we had this big iron ore crash and a number of commodities, a bunch of commodities crashed. And then they turned it all back on again and took it back even above that prior heights. And now we've crashed again we're now below the levels we sort of hit in 2015. And but they're still really high. You could still knock off another 30-odd% and you'd be back at what you call a more normal economy for the amount of property. And China's been building a lot for a long time. So, could it fall by 50% again from where it is today and stay there for a few years before sort of then bouncing back to a higher, sort of more sustainable level? Yeah, absolutely. They've got lots of unsold property and lots of probably more unfinished property. So there's that. And then keep in mind as well, so that's sort of what's been happening with those. I've got I might do this one actually. Over that same time frame, this is roughly your change in urban population. So the blue lines are sort of showing you that over a 5-year period, I think it's like 130 odd million people. From 2013 to 2017, you had about 130 odd million people move into cities. That fell to 100 million for the last 5 years. So there's been a 25% drop in the number of people moving into cities, and at the same time, China increased the amount of building they were doing. And so I've sort of I run a few different scenarios, but one is basically saying, well, could they just keep pumping it out at this current rate? And you go, yeah, well, they could. That just means the next 5 years after that, well, actually, if they do that, they'll basically be pretty much at developed country levels of urbanization by the time they finish that. So they could basically keep running the foot to the floor. If you look at a more normal one where they gradually sort of taper off, that's the red line there, and that's basically half the level you were from 2013 to 2017. So there's just way less people moving into cities, like just demographically. And then there's been a bit of data come out. There was basically a hack of a whole bunch of Chinese personal data, and I mean, for years there's been speculation that China was over-reporting the number of births and the number of children it had, and there's some people have done some work, say using other different bits of data, like the amount of vaccines that are being administered and to kids and things like that, to basically think that that maybe there was actually 5 or 10 million fewer kids per year being born than what they'd said. And then this hack came out with a bunch of data that that when people sort of back calculated the data, it actually fell in line with this other vaccine data. And so I guess what I'm saying is I'm showing you this scenario based on Chinese official data, but it is possible that some of these conspiracy theories are at least directionally right, and that China actually already has far fewer people than what we think, and the demographic headwind is even far greater than what I've shown here.
That's an amazing thought, because of course the whole philosophy, the expectation of China was getting bigger and bigger and bigger. In fact, the rate of growth is slowing, and the aging. This is more like Japan, is it?
Yeah. Oh, well, yeah. Japan. Well, at the moment it looks like Japan, but if the stats are like this leaked data, the stats and the theories, which I don't know if they're right. And then look, China doesn't report those numbers, and so, but if they were right, then it's way worse than China, way worse than Japan. Yeah. Based on current figures, you're looking at Japan just backtrack. But
it also implies lots of that vacant property will be even more vacant.
Yeah,
right.
Yeah, you might just never fill it.
So property prices continuing down, rate of construction continuing to fall, demand for raw materials falling.
Well, there is one for every 6 urban households. There is one apartment being built.
Yep.
Right now, which hasn't been finished.
Yes.
Yeah. So it's a crazy number, and so could China be the place for a financial accident? Absolutely. Could they be exporting deflation and exporting these problems to others? Yep, absolutely. There's one thing I was going to say on that one as well. Oh, because that's I haven't got any charts on it, but there was some data out on Wood Mackenzie came out talking about copper this week, and talking about saying, oh look, we might not have enough copper to fund the whole net zero. And when you dig into their numbers, one is they've made some really different assumptions than others just about the technologies. So basically, they've basically said, oh, if all these really copper heavy technologies are the ones that win, then that's one part of it. But the other part was they've got all this sort of natural growth sort of factored into their system, and they haven't catered anything for the fall in Chinese property coming off. And that's because that's where I look and say, well, yeah, there's always a broad spectrum of the way things could come out. But if Chinese property keeps falling, and the technologies that win in in EVs are the less copper heavy ones, then we might actually need less copper than and sorry, and then the other next part is if you end up with more less centralized grids and more sort of microgrids in terms of going, you produce a lot of solar panels power and wind power and you run a few gas turbines, but then you store lots of energy in batteries and pumped hydro in local areas, then we could. So I don't think there'll be less copper needed, but I think that's a sort of relative extreme case on one side, but I think Wood Mackenzie's taken the opposite case, and the answer's probably closer to the there's plenty of copper around. We'll be fine, but a lot of it comes down to Chinese building, because that is the biggest customer for steel. It's the biggest customer for copper. One of the biggest coppers for nickel. There's all these commodities that just get used by Chinese property that will get freed up.
Yeah, very interesting. And the other thing I was reading about on China, which is sort of connected, is that the consumer boom, which was that we're trying to migrate to a consumer boom, right? So get people to consume more, isn't going that well. So if you look at the consumption numbers, they're nowhere near where people thought they were going to be. Yeah,
and I think I don't know. There's a couple of good guys. Michael Pettis in particular, for anyone he does some very good things on this, and he's been saying for years that it's not going to work, and basically the logic, which rings very true to me, is that so China has effectively one of their problems is that they've got a very small consumer sector. So when you look at the total GDP, the amount that consumers actually make up of that GDP is very low. And so what you need transfers from governments, and you need transfers from corporates across into that sector, and then they can spend more money and sort of drive the economy. But all the things that China's been doing have all been about helping corporates and about helping governments. None of it's been, well, not none of it, but very little of it has been what most Western countries did, which was direct transfers into the consumer sector. So arguably the country that most needs money transferred from the government into the consumer sector during COVID had the least amount. And so, and plus they've had all, the lockdowns continue, and they're still got that zero COVID, and they haven't got a vaccine really that works. And so, it's not particularly surprising that the Chinese consumer hasn't, has continued to be constrained and hasn't sort of stepped up to take over until they actually run specific policies to try and transfer wealth from state-owned entities and governments across into consumers. It's unlikely to see that they're going to reverse that.
Absolutely, yeah. Well, it's certainly fascinating to watch that, and of course, because of the connection between what happens to our trade, China, 35% of all trade from Australia goes to China. It's a significant element within the whole scheme of things, right?
I know, and most of that's because they don't even want most of our stuff anymore.
No,
they've been sending it all back. That's basically iron ore and coal.
Exactly. So that. Question mark about the future economic trajectory of Australia, right? Yeah,
and there's some pretty good. So the iron ore is one. I mean, and that all comes back to that China's housing. That if that's what uses most of it. That there's a lot of Chinese infrastructure being built, but infrastructure is not as steel heavy, surprisingly, as buildings. Buildings actually use way more steel, even than like you think about building. Kilometres and kilometres of rail lines, and actually the rail lines themselves don't use that much steel. A bridge uses a lot of steel, but a bridge often wouldn't use a similar amount of steel or even less than a building. And so you're obviously building a lot more high-rise buildings than what you are bridges. So infrastructure will help ease it. But they are running out of infrastructure to build, or not. I mean, you can always build more, but the infrastructure they've got is not utilised fully now, and so it's pretty hard to say, okay, we've got an airport, it's at 20% capacity, and let's go build another one because we really need to spend money.
Yeah.
Or here's a bridge that nobody uses, and we're going to go build another bridge next to it, so that because we really need to spend money to keep the economy going. It's a real it's a waste. They're not productive investments at this point. So it was infrastructure, and then and the coal part is, so Russia has got a lot of coal, and coal's a lot more transportable, a lot more easily transportable than gas. So Russia's got to get its coal to somebody that wants to buy it, and so China is sort of the obvious. China actually has a lot of coal itself, and some of China has the most amount of coal of any country in the world. It's just they haven't been efficient at pulling it all out, and so and as they're sort of switching gradually to other technologies, nuclear and renewables, they will be using less coal, and they actually do have enough coal to use themselves, and it's a pretty good assumption to make that the coal they don't have, or any shortfalls, they'll probably end up getting from Russia.
Absolutely. Well, it just shows a lot of moving parts. Now, I guess as we sort of come to the last 10 minutes or so, what does this all mean for managing investment portfolios? I mean, there are so many moving parts, right? And there are so many countervailing forces. So you've often said, well, you have to sort of on one hand think it could go this way, but then I need to also take account of that it might go that way.
Yeah.
So how are you teasing this all out at the moment?
Yeah, so I mean, having a relatively diversified portfolio is one part of it, but the real issue for me is the question about bonds at the moment. So bond prices have been rising. Bond prices have been falling and yields have been rising. So ideally, bonds usually protect you when equities are falling, and that hasn't happened this time because of the inflation.
Yep.
The question is, it's about sequencing. So if we're right, and central banks is basically going to keep raising rates until they break something, and then they're going to stop for a little while, and then they're going to survey the damage, and then they're going to realize they've done too much, and then they're going to reverse, is basically our basic thesis, is that bonds should be falling earlier than equities. You should see bond prices fall. At the same time, earnings should be falling, so equities will be falling. Bond yields will be falling, bond prices will be rising at that point, and equities will be falling as their earnings falls. And then it's a time at some stage there. It's time to switch out of those bonds and back into the equities. The main issue is, look, the way the market's been reacting now is the days when bond yields fall are the days when the market puts on 2 or 3%, and so they're both acting together at this point. And the question is, are they now going to act together, consistently? Is that what's going to be? They'll both turn together. They're both going to fall together and then eventually rise together. I don't think that's going to be the case, but I have to acknowledge that there's a risk in that. I do think the sequencing will still be that central banks will reach the end, and they'll start talking about whether they need to cut rates, and that at that point bond yields will tank. Equities will probably go for a little run, and then earnings downgrades will be factored in, and unemployment, and that'll bring them back down again before getting set for the next cycle. But the other thing I do want to say as well, look, markets are down a long way already.
Yep.
Now's the time to be having your list of your really high quality stocks that you want to buy, and you've just got your prices of, okay, at this level, I'm happy to own this stock regardless of whether if it happens to fall, I'll just buy a little bit more or whatever. I think in the long term, I'm actually going to make money from this. So, and when I say good quality stocks, like I'm talking the whole, stable earnings. They have good margins. They get growth. They get return on equity as they invest, and sort of market leaders and things like that. I'm not talking about and in good industries, because you can have companies that might be good. So let's say you're a tire manufacturer, as an example. If you're a Bridgestone or a Michelin or something like that, you might be good. You might make really nice tires and all that sort of stuff. But the reality is you don't have any pricing power. If you double the price of your tires, everyone's just going to go buy your competitors' products. And so you might be a great company and well run, but you're just in an industry that's going to go through its ups and downs, and you're never really going to make much. But you can find the other ones are sort of, your Microsofts and your LVMHs and ASML is a really interesting one that's does chips and or machines that make chips, and a bunch of these companies that we've still got our eye on that are like, we either own them already or we want to buy them, and the question is, you can pick them up over the next year or two at a price that you can then stick it in the bottom drawer and forget about it.
Yeah, and I think that's the point. It's important to take a long-term view, isn't it? Rather than actually just sort of, we often talk about the difference between building a portfolio and just trading, right? I mean, there are people just trying to ride the volatility up and down and what have you. But this is about value stocks that you identify.
Quality stocks.
Yeah.
So the distinction there is that value something can appear and disappear really easily, because I can go, a stock price doubles, it's no longer a value stock. The stock price halves, it's no longer, it sounds cheap. But the quality part about saying, I want to find the stocks that are earning those good returns, and I can just buy it and not buy it and own it forever, so to speak. Versus if I'm buying, a Bridgestone or a car manufacturer or something like that, I just want to buy it when it's cheap, and if it goes up, okay, I'm out. I'm on to the next stock. Whereas, find those good ones, you can just leave them in your portfolio and really get the benefits of capital gains and all that sort of stuff.
And the other question is sort of split between Australia and international.
Yeah. Look, the Aussie dollar has been really helpful. So last month, I think the world market might have been, or maybe the US might have been down like 9% and sort of, maybe 4% in or less than that in Aussie dollar terms. So you've really had that cushioning. So that's been very helpful. I still think there's a little bit more left in that, and I do think that Australia is going to have some relatively unique problems in terms of one, our debt. We could see some debt problems, and the RBA, I think, has been acting, as we spoke, been doing more than what you might think they should be doing, or certainly what I think they should be doing. And then the other issue in Australia was just general commodity prices.
Yeah.
Tend to be late in terms of when and particularly some of the energy prices, is effectively what the Fed's saying in a way is that because a lot of this inflation is driven by energy, is we've got to raise rates so high that people stop buying energy and stop buying petrol.
Yep.
And so that means a relatively big recession. It means, though, as well, that's one of the last things you'll actually see to roll over. So that's, people will quickly cut the more discretionary spending. The bit about, okay, I'm now going to drive my car less, and now I'm going to, heat my house less, or things like that. That's one of the last decisions you make in terms of where you can spend. You need to really be hit hard in terms of that for economically.
Yeah. So it shows you just how complicated this whole matrix is, right? And I remember last week in your presentation, you showed a bit of a chart that showed, from the lower value to the higher value, and the ones you want to hold versus not, right? There's a bit of science behind all of this.
Yeah, absolutely. And I think that's for everyone. Having a method to it is and a process with the idea that it's if your investment style is, I'll pick up the paper and see, or go to my favorite website and see what looks interesting this one. It's very hard to improve on that. It's like, I'll try and be smarter next time. I'll try. Whereas if you have a process, regardless of whatever that process is, of this is my process of how I'm buying and things like that, you can always then improve on that process and say, okay, here's what I've learned. This is what I'm going to do differently, or things have changed. Here's how I'm changing my process to counter for the fact that we just had a pandemic. But yeah, and so that's the big thing I'd say is, get a process in it, because the process you can improve. Whereas the random, I'll buy what sounds good, is you're almost always going to be buying what other people are doing. And actually that's a slightly off topic, but probably a good illustration is, there's a lot of brokers who really pushed at the start of this year, commodities is the only thing that's going to save you from inflation. Inflation's here, got to buy commodities. Now, energy, that's been a terrible trade.
Yep.
You had to be buying those commodities, 2 years ago.
Yep.
Yeah. And the thing is, though, a lot of those brokers, they had a lot of clients in those. They need those clients to get out. And so they need to find somebody to buy it. And so the fact that all you're hearing everywhere is commodities, got to have commodities, Martin. Inflation's here, Martin. Grab commodities, because otherwise you're done. And in the meantime, iron ore's down from 150 to under 100, and copper's from 10,000 to 7,000. And there's just like bam, 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 bam. Every single one of these is sort of as not every single one, but a lot of them have all fallen. And so the story you're hearing in the mainstream press about whatever it is probably already priced into the stocks.
Absolutely. And it's just worth underscoring, Damien, they always have agendas, right?
Yes, it has agenda. Me too. I've got an agenda.
Well, you've got an agenda too. We all have. But the point is that when it comes to what the media are writing about, and particularly the talking heads are talking about, it's not necessarily independent, objective, right? They'll have an agenda.
Absolutely.
Yeah.
And that's, it's the part about, especially for individual stocks and big sector calls, is that you just need to make sure, look, is this person already invested in this asset and they're just trying to convince me to buy it as well? Or are they actually
on the other side of the trade?
On the other side of the trade. Yeah, that's right. I'm already in this asset, but I need someone to get me out of it, especially the big ones.
Exactly right.
You don't have to get that about us that much, because we're dealing in large cap stocks and we're not that big. But when you've got a Morgan Stanley or a Goldman Sachs telling you, buy commodities, saying, okay,
and of course the way that those very large houses are then reported in the media, right? So they become thus saith, and so it's then reported as fact, and then people then follow, right? So I always say, just understand some of the processes, the philosophical processes under the water here, right? Rather than just take it all at face value, because quite often there's a bit more going on below the waterline.
Well, there's a hedge fund out there, and their whole strategy is they pay stockbrokers a split of like they let stockbrokers do the investment for them, and pay the stockbrokers a split of what they buy. But when you go through the quantitative strategy, it's basically the background to it is, when a stockbroker has got an idea, here's a stock I want to buy and I'm going to go out and push it. They will generally they'll go out and tell all their institutional clients, and that will push the price up. But the way they're rewarded now, they're basically the first thing the stockbroker does is place a trade with this hedge fund, and then go out and tell all their clients to go buy this stock. And I think it's a week, maybe it's 2 weeks, but basically their holding period is like it's like a week or 2 weeks, because that's the attention span of most brokers with a story. They'll run up there and buy XYZ stock because whatever, I've decided I really like it, and I'm going to go out and convince more of my institutional clients to do it. And so these guys are basically trying to front run it, but it's like a week. It's not like this is going to be this is my 5-year story. It's like can I make money from it, this week or next week?
Yeah. Well, there are lots of people trying to make money and turning it quite quickly. It's part of the architecture, I fear. And we're close to the end of the show. We should just, I think, underscore that you run obviously the Nucleus Wealth portfolios. You also run the World portfolios, powered by Nucleus Wealth. And if people want to find more about what the options are that you have, very transparent, significant portfolio of different ways of managing funds, from full transparency, making decisions yourself, through to full transparency where you make the decisions on behalf of clients. The reason that we're having this conversation is because we think it's important that people actually know more about what's going on, and also have transparency in the portfolios. And for me, that's the big sell when it comes to what you do.
Yeah, absolutely. So the idea of the transparency is that you can see every asset within the portfolio. So we know you've got other things you're doing, and if you've got a bunch of money tied up in, say, a super fund, and you've got no idea what they're invested in, it's very hard for you to know what to do with your other assets. Whereas if you can see, okay, these guys have all that, and if you've got say you've got banking shares yourself, we can knock out all the banks out of the portfolio for you. Or if you happen to work for a company that's in the mining industry, and so you go like, well, you're making profits from that, and you might be getting paid in shares or whatever it is. You don't need any more exposure to the mining industry. Let's cut all that out completely out of your portfolio. But at least you can see what's in there and make those decisions as to what you want to do.
And if you compare that with a typical large super fund where they don't tell you much about what's in the box, right?
No,
nor what they're charging for what's in the box.
Yeah,
it just amazes me how little people know about what's actually going on.
Yeah, absolutely. There's we've got planners on who you can talk to, and it's always amazing that the fees that people think they're paying are often not the fees, because that's the headline fee is, you're getting charged whatever 0.7% for management fees, and they're like, that's what I'm getting charged. And then you dig through and they're like, but you're also, they're putting you into products they also own, and these products might be listed and they've got another fee. There's another 0.5% behind that, and they've put you onto a platform that's got another 0.3% or whatever, and you plus, and people might end up paying 1.5% for something they thought they were paying 0.7 for.
Yeah, and I just want to underscore the fee question is so critical, right? Because in terms of the cumulative returns over years, if you double the fee, your overall return drops dramatically.
Yep, dramatically. Especially if we're in a low return environment, yep. As we've been for the last number of years. That, yep. that fee, the difference between 1.5% and 0.5% makes a huge difference over a period of time.
And it surprises me, but many people actually don't know what their fees are, and they can't find out. So there's a clue there. If you can't find out, there's a reason, right?
Yeah, that's right. Don't assume the best. Yes,
exactly.
Yeah.
Well, Damien, I want to say thank you very much. A very informative conversation this evening. Some great questions from the audience as well. And we'll do it all again in about a month's time. By which, of course, who knows where we'll be, but it'll be a very interesting conversation as always. So thank you once again.
Yeah, thanks, Martin. Hopefully nothing we've said here has been superseded by the budget.
Well,
is that wrong?
We'll follow up as necessary. And we'll put links and things below if people want to follow up. Thank you very much. I'm going to take you offline and I'm going to close the show. See ya.
Bye. Thanks. Bye.
So there you go. A very interesting conversation. Certainly a lot of ground covered, and it shows you some interesting permutations in terms of what's going on in the world of the markets at the moment. Just to say that next week I'll be running a show when I'll be updating my household finances and modelling for the month of October. Bit of a rush because it's 1 November, but we can do that. Of course, the RBA will be meeting a week later. So mark your diaries for that. And if you want to have a last glimpse of the dogs are, she's having a bit of a dig around the bed. So Luna's going around in circles at the moment. There you go, just to show that she still has a bit of life. I went and shut the door when Damien was talking, and that kept them quiet. They're not chasing the possums, but when I take them out, they'll be chasing the possums. Anyway, I want to say thank you very much for spending some time with us this evening. I hope you found that useful. Keep following the other shows during the week, and join us again next week for another live next Tuesday. This is Martin North from Digital Finance Analytics signing off. We'll see you next time. Cheerio.